All right, everybody. Good morning. Good morning. We have a number of things on the table today, and they can cause a liquidity gap. So we're going to review what a liquidity gap looks like. Even if you don't want to trade it, at the very least, you can recognize what it is so that you don't try to trade it in the wrong direction. So today we've got a number of economic calendar events, including QRA at 8:30, which is not listed here. It's not listed on most places actually, but you will find it on Finance Juice. It's one of the few places. And I've emailed a lot of these guys and asked them to put it on there over the last few years. I don't mean anything to anybody, so they probably just ignore me. But you hear about it more and more, so the word's getting out. We've got crude oil inventories. We've got QRA. We've got a relatively wide range on the ADP, -32 to a +22. The 32 negative was the previous number, and the forecast is +22. That's a really wide number, and that wide number all by itself is worth keeping an eye on. If it comes in well, then that's one thing. But if it's way off the mark, that'll be another thing. Markets don't like to be off size. They don't like surprise numbers. And when the numbers are this far apart, you have both of those opportunities elevated. Then we've got the PMI 945 and ISM at 10. The other two, I mean, look at them. There's no real difference there. So unless we get an outlier that shakes things up, those two shouldn't be the issue. But this one at 8:15 is right in front of the QRA at 8:30. So at 10:30, we've got the oil. And by lunch, we should be good unless there's something coming out of the White House this afternoon. And, looking at this, it doesn't seem like we have anything coming out of the White House. I did hear some talk that perhaps there is progress made on the shutdown, but at this point, I'm going to just say I'm from Missouri and you got to show me, right? It's the show me state. If you look at the CTA positioning, they are not allocated back to their extremes, but they are still holding a significant level of allocation. And they're not dumping it out yet, right? So they reduced risk a little bit, and they've been holding the line here, whether it's the S&P or the NASDAQ, they both look the same, right? There's no real difference here. This is the NASDAQ version. And sure, that drop down, felt pretty violent, but they stopped and they've been holding out. So, they reduced position size a little bit and now they're holding the line. You look at something like Brent. I mean, come on, that is an exit. That's GTFO right there, right? Look at crude oil, gold. So we're not doing that in the S&P and in the NASDAQ. We're holding in that tight range. If we break out of that tight range to the downside, then we would have something more to talk about, but we're not there yet. All right, so a liquidity gap. First of all, there is no gap. You don't actually see a gap. It's not like the price action gap where we're looking at one candle's close and a new candle's open, we're talking about a gap in liquidity. The idea is at 8:30, we're going to get information that can cause one of these really big candles to form. You can get these candles in the middle of the day. There's nothing that says it has to happen during an economic event. Plus, we do get economic events in the middle of the day. But beside that, it can just be headline news. Anything that just spikes us and causes us to get a really big candle. And it doesn't have to be green. It doesn't have to be red. What I'm looking for, if I want to trade a gap close play, is that there's no wick on one end. That's usually the starting end. And that whatever direction it goes in, I want it to close in the upper 25%. So if we was to think of this candle in 4 parts, marking out the half would show us if we were above or below 50%, and marking out 4 quarters would show us the 4. What's that button? There we go. Show us the 4 quarters that we need. We want it to close in the farthest quarter. So if it was red, close near the end to the downside, and if it's green, close near the end on the upside. That's if I want to trade it. Now, whether it's tradable or not, say we get big wicks on each side and we close near where we opened, well, then there is no gap to really play because we closed pretty much where we started. But we can still use that big candle. Every technical analysis candle book talks about ranges and how you can measure a range and you can project above and below that range 50% and 100%. Well, range is range. So if I mark one single 5-minute candle, sure, on that 5-minute chart, it's just one bar. But if I went down to a 30-second chart, that'd be a lot of candles, right? Now, since I've got a lot of candles, it formed a range. So anything can be a range, any one single bar. We measure that one bar, project it higher. And if you look at where this particular chart stopped that day, if we had marked 50% and 100% and laid it higher, that's where we stalled out. Same thing when price came back inside the candle, it hit the midpoint, that's where it stalled out. So even if we don't get a gap close, this one did not close. For an example, that was a CPI day. We never came down, we never got the gap closed. But using that one 5-minute bar and marking out the mid and projecting above it 50% and 100% would have given us tradable opportunities, and it would have given us something to use to evaluate the market. We can use that candle for our analysis. This one was a liquidity gap close. No real gap on the start side. It closed in the upper 25%. And we got the liquidity gap closed around 10:30 or 11 o'clock. Here's another one to the downside, same thing, no real wick, closed in the lower 25%, put in a little bit of a base, got the gap closed around 10:30 or 11 o'clock. Kind of catch the theme on that, right? These gaps tend to close in the morning session before the end of lunch. Here's another one, CPI day, no wick on the starting side. This one's a little different. We closed in the upper 25%. We put in a pause candle that pretty much stayed in that wick range. Then we continued on, put in the base, got the gap closed between 10:30 and 11 o'clock. So that's what we're looking for today, is a liquidity candle. Whether or not we're going to get a liquidity gap will determine if it looks like this with a bunch of wicks on each side, in which case there is no gap to play, or if it looks like the other ones that I was showing where it closed in the farthest distance away from where it opened. If it's like this with big wicks, there's no gap, but we still want to measure that range, mark the 50%, project above or below, because we could have broke down instead of breaking up, project outside that bar 50% and 100%. If we had done that in this one, that's where we were topping out that day. Here's another example. It's a event bar. Mark the mid. Project higher and lower, 50% and 100%. It's where we stalled out. We came down and caught the mid. So there was opportunities to trade, but not just trading it, right? It offers you an opportunity to evaluate and analyze where price is likely going to hit resistance, where it's going to pause, maybe even reverse. So here's another event bar, same situation. Mark the mid, project 50% and 100%, which is where we stalled out. So we're going to get candles like this today. 8:15, 8:30, 10:30. Those are all possible times that we could get this set up. Now, again, once you get used to it and you're familiar with its shape and its presentation, you'll begin to notice that it happens all over the place. You'll see it on the intraday, in the Globex, even without, economic calendar events. It can just be headline news and not even that big of news that can cause those sort of candles to show. We closed at 67.61 in the SPX. You can see if we look to the upside, we got 6,800 here, and that's not really all that big, but we don't start to see any real resistance until 68.50. That's the gamma structure that's over our head. Yeah, that's bright white early in the morning. All right, so this is from Gamma Lab. It's their little briefing that they wrote up. They were talking about a dealer flip point. If the market drops below the gamma neutral level of 67.50, then we're going to swap to negative dealer positioning, in which case they sell into selling and they buy into buying. That's not normally what they do, right? Normally, they buy into weakness and sell into strength. And if we get into negative gamma, we're going to flip that around and go the other way. So sell-offs will become more violent and rallies will become stronger if we're in negative gamma. And we are at zero gamma line. What we were looking at was not spot gamma, but spot gamma agrees with them, with us being at that zero line. We're there again. So we got the 3-week moving average. We're underneath the 3, the 10, the 20 day. We're underneath the volatility trigger. The put wall got rolled up a little bit. And we've got some additional liquidity in the overnight. It's not as big as yesterday, but it's still higher than the average. And the average we've been running has been around 50 to 70. So coming in at 92,000, sure, it's lighter than yesterday, but it's still heavier than the average. If we wanted to make a move to the upside, you can see that 20 period. It's the green line here. That's the 20-day moving average. It's the same as this green line here, right? I just moved that daily moving average onto my intraday chart. We would need to wick down, run all the way back up, get through the midpoint of the previous day, challenge the top, which was the open and the close of the previous day, so a double layer, and then work our way back up. We can absolutely do that. This could end up forming like a scoop pattern, which, eventually turns into like a cup. Maybe you get a handle, maybe not. But to get a scoop, we would expect to kind of base down here first and then go up, because, cups really got to have the flat spot. We could also just V back up. which means we wouldn't put in much of a base down here. We would just turn right around and run right back up again. The S&P's got a lot of examples of both. Even if we do base like we did back here, it could just be a one-day base, and then we just work our way right back up again. This is starting to develop a little bit like a TRB setup, but these big wicks are going to mess everything up. Because if we were looking for like the, what do they call it, the shotgun play or the popcorn play, those wicks mess it all up, and so does this really big down bar. That messes the whole concept up. But for TRB, we'd still be just running right back to that 69.50 because that's what it owes us. If it's a TRB, we'd make the move, nearly the whole move in a single shot, one candle, one day, one move. Otherwise, we can just work our way back up. And if we're going to stall, there's two big places that we could stall at. One of those stall points is the midpoint of yesterday. So 68.32-ish, I guess is close enough. And then here, 68.50. $68.32 is a cog line. 68.50 is a big options level. Both of those are going to be significant resistance levels, not counting all of the moving averages. If we break our own low here, that 67.47 or 48, whatever it is, break that, we're going to this 50. If we can cut through the 50 day, then we're going to the 50 number. It's 66.50. I told you guys back here at 69.50 that we're running 50s from 69.50 to 68.50, 68 to 67.50. If we break under that, then 66.50 is on the table. If we get an overshoot, we get into 6,600 with 65.50. And I know that sounds drastic and it's a long ways off. And that's what everybody said to me. And then we got that big candle. So, you know, 65.50, and it turned around and went back the other direction, right? I get it. I'm not saying we're going to go there. Just level by level, if we break one, we open the door to the next one. And if we break that, we open the door to the next one. So it's just running it one level at a time. They're not hedging today, oddly enough. There's no market maker move up here. So they're not concerned. Maybe they're really confident in the numbers, or they already had plenty of time to hedge and they didn't come in and add more. I don't like that argument that they already had time to hedge, because they've always already had plenty of time to hedge, and we still see them come in a lot of times and add additional hedges. They're not doing that this morning. The QRA preview that we got on Monday showed no real change, except that they were going to focus more on the front end of the curve, and it wasn't radical. As I've talked about before, when it comes to QRA, if they're not making big changes, then it's pretty much just same old, and we don't expect big reactions from QRA. This kind of emphasizes the lack of hedging, anyways, implies that the market's in agreement with that. We're not seeing big changes, so they're not expecting a lot of volatility out of that data print at 8:30. The one for 8:15, since it's a positive number and it's a big change from -32 to +22, the market must see that as a positive, because again, no hedge. So keep your eye on it. Maybe they start to hedge, but it's a bit late now. We're going to get the data in what, 25 minutes? If they were going to do it, they should have already done it like an hour ago. We've already hit the lower edge of the ADR. I know it doesn't show that we hit it because the line started at 1 a.m., but depending on what platform you use, that line would have started last night. That's where the math is based on it. Where we open at 6 o'clock is where these lines get set. So just because it isn't showing the line running clear across here all night long, we hit the lower ADR, and that means we can hit the upper ADR by the end of the day. That's not going to be considered bullish either. It's just a function of wave, right? You can see it on the chart. We go down, we come up, we go down, we come up. That's what we do, right? So if we hit that and we come up and hit this, that's not bullish. It's just price performing that wave. If we break our own Globex low, that 67.50, then we'll target the ADR full. And if we get through that, we can look at the ADR and we can split it and add to it again, right? How many ADRs can we get, right? A full ADR is 1.3. If we was to double it, then we would move 2.6 on the day. The easiest way to do that is just to take and draw the whole box. It's not to the tick perfect, but that gets us down to 66.70. It's just adding another 25%, right? You could have done it this way if you wanted to do it like that. Either way. A 2.5% move on a bearish or a bullish day is a good stopping point for the S&P. So I like that. 2.6, 2.5 is pretty close. I wouldn't haggle over a dime. Otherwise, if we cross over, then we've got this shorter time frame TRB. Run across, get through the ADR half, then run for the full, which should get us back up into this previous cluster. 6,900, 68.92, right up in that area. All right. I've tried to quantify over the years how far away from the floor pivot weekly can we get before it's too much. And unfortunately, because it resets every week, completely different than a moving average, we can't run it the way that we check distance from moving average, like distance from 10. So I had to go in and hand draw the distances, add them all up, and then try to find the average. And to the downside, the average was greater than to the upside. We could get farther away from the weekly pivot when we're underneath it than we could if we were above it. 2% is not enough. So if we were looking for some sort of mean reversion because we had gone too far to the downside and escaped the boundaries of the weekly expected move or the weekly pivot, we haven't gone too far away from that weekly pivot yet. What we also want to check, though, going into Monday is how far away we open from the new weekly floor pivot. But that's not for this week, right? That's for next week. At this point, we're underneath the weekly. We were around 2%. And that was a nice pause point. But we could run another 2% away from this thing, get 4% away from it in 1 week before we would need to consider that we've run about as much as we should run for 1 weekend. We're not there yet. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. Price expects to hit that pivot point every day. So that's mildly bullish on the expectation that we should run up and hit that pivot. we would hit the pivot around 75% of the time. But that doesn't mean we're always going to hit it, right? 25% of the time, we're not going to hit it. So far today, we have not hit it, and that makes it an MDP. That's a missed daily pivot. There's a strategy that goes with that. I don't trade it. But if you learn the strategy, then you can use these pivots in your analysis, even if you have no intentions of ever trading the strategy itself. It's not my strategy. You just go to Google or go to YouTube and type in missed daily pivots, and you should be able to find the videos of the guy who teaches it. Rob something. I don't remember. But either way, it's something to learn and kind of pick up, even if you don't want to trade it as a strategy. This MDP doesn't count until tomorrow, when we can look back and say, oh yeah, look, yesterday we didn't hit the pivot. But until tomorrow, it doesn't count, because at any point today, we could run up and hit the pivot, and then it wouldn't be a missed daily pivot. So we have that bias or that expectation that we're going to hit it today, because, well, that's what we do most of the time. And we've already made that downside move. So we're kind of looking for the reversal and the run back up. There's a lot of examples where the S&P at the bottom of a move gives us this really nice wick play, and it reverses and runs back up. Right? I love this setup. Generally, I would want to have fallen farther first, but this little rope-a-dope loopy play, I love this. And having a hammer here is a good start. The problem is, well, today's not done yet. This doesn't have to stay looking like a hammer. But if we go up just a little bit more, it's going to turn green. And then we could end up with a green bar, maybe something that looks like that one. I'll move the chart so we can see it in a second. To where we have this big wick below, and then we end up running all the way back up and closing a lot higher, just like this one here. All right, so that's what today could end up looking like, for all we know. The wick wasn't as deep as this one was, but you get the idea. And if we get that sort of rounded reversal at the bottom of a really nice run like that, it's pretty common for the S&P. That's a normal setup. And I like that one. There's another example of it. In fact, that one's more matching what we have today. Nice little 4 or 5 candles to the downside. We get that loop on the bottom, runs back up, and then closes higher than it opened. So it gives us a green day. And it's not extreme. Right? Of course, it had a nice follow through, got us back up to the top of the range. We're looking at this one back here. The point is, I'm still not heavily bearish. I know a lot of people are jumping on the I'm bearish bandwagon, but I'm not there. We got a lot of market breadth signals that are breaking down and reasons to believe that we should be bearish, but they all came out in unison yesterday and started talking trash about, oh, we're overbought and we're overvalued and we're likely going to get a plus 10% pullback in the S&P. And then at the last second, they said, but within the next 2 years. Well, I could ask the bag boy at the grocery store if he thinks the market's going to pull back in the next 2 years and get the same answer. All right. That is so generic and vague. What it sounds like is, you know what we need? We need you to sell your stuff so we can buy it. That's what I heard. You should totally liquidate your positions so that we can buy your positions. We'll see. Either way, we don't have a downtrend. Our uptrend is still intact. It ain't broken. And while there's a lot of bricks in the wall of worry, we've had those bricks all year long. And we've just climbed and climbed and climbed and climbed. All right, this week is building out into a nice double distribution. We can see that shallow area around the 68.50 zone, which it's weird how it does that, right? 50 is what we were aiming for. You would expect that we would have a lot of volume at that level. And yet it's where we had the shallowest amount of volume, the least amount of volume in these two distributions. We ran right through it and came all the way down to the 6,800. I'm still a fan of my 50s, but this isn't the first time where they've skipped any trades along that 50 spot and we went right through it, right? If you look back here, we had that happen on other 50s. So if we can get through the point of control around a 6811 cog line, get through all of this resistance, we can run up to this previous zone. But that previous zone matches last week's point of control, and that's going to be a significant area that we're going to have to deal with. I don't think we're going to be able to get through that before the next OPEX without some help. I don't know what that help is going to be. Maybe an end to the government shutdown, or some new news from NVIDIA, AMD, blah blah blah, right? Something in that space. I don't know, but I don't think we got the juice to get through there on our own, and we need something to fire us up. Not for nothing, but we're on the October anchored VWAP too. See if that does anything for us. All right, 10-day, 30-minute volume profile and TPO. They both match up with that point of control really nice, but we're outside of the value area. And while we're putting in new prints down here, I'm not expecting to see that point of control move anytime soon. And when it does finally move, at least at this point, it's still going to be over our head around that 68.32 area. So that's not going to be helpful. We got to get that thing underneath us, or we need enough juice to get through it. And at right now, we don't have either one. So I don't know what it's going to take. We need to hang out down here and put in a base, or we need a lot of liquidity to come in down here instead of these really thin lows. We got to break this. And so far, we haven't been able to do that. All right, we took out that VPOC. We're done with it. We still have the one overhead that we marked out from Monday. The one last night, we can make the same argument that we made for the one that we marked on Monday, that it was just a tiny little wick and that we shouldn't consider this one broken yet. This is why technical analysis gets a bad rap, right? Because some things we just don't have an answer for, and traders have to decide for themselves what the rule is going to be. This level was hit. There's no arguing that, right? It has been hit. I'm not going to get this to the tick. I'm just going to get it to the closest point. Doesn't matter which one I use. We wicked into it last night, and we ran completely through it. It's not like we stopped on the line either. So in theory, this should be considered hit, and we're done. It should not be marked. But exceptions to the rule, right? It happened right at the first bar. It was in the overnight. And I still consider it a key area of interest that I think should still be on our radar. And that's the number one takeaway. That's why we mark the lines in the first place, because we're trying to highlight a key area that should still be respected and that should deserve our attention. And this one certainly has my attention, so I'm going to keep it marked. So you do you. If you want to, be a stickler for the rules and not mark it because it's been hit, then, you do that. The textbooks are going to tell you to mark all three of these lines, whether they've been hit or not, and carry them into today's trading no matter what. I don't do that. I've already got enough pivot points. I don't need that many more. And we did hit the edge of the weekly expected move. 67, 68, or 66. We took that out. We're back above it. I've got a strategy that says if we get to the edge on Monday or Tuesday, that you should attempt to go the other direction. You could put in like a put credit spread, or you could buy calls. I'm not a big fan of buying calls. Say this was the SPX instead of the ES. Just because we say we think it's not going to go down anymore does not necessarily mean we think it's going to go up now. And if you buy calls, well, you kind of need it to go up. Calls are going to pay you only if we move in the right direction. But selling puts says, hey, as long as we stay above the line in the sand from the break even of the puts, I'm going to make my money. We don't have to go up. We just have to stop going down. And that's a lot easier. Now, you could do both. You could sell some puts and use the money to buy some calls. For me, in this scenario, when I have done Wednesdays, I'm not a big fan of Wednesdays. I'd rather get there on a Monday or a Tuesday. But if I do it on a Wednesday, the calls that I buy are on the other side of the road completely. I don't get them near the money the way I generally do, or in the money the way I generally do. This is time for those cheap lottos with a Friday expiration. That way you can get it as cheap as possible. And we either run up there and we hit it, or it's a complete loss. There's no middle ground. And that's why you want it as cheap as possible. Don't be afraid of taking a loss, right? It's having control of how much you're going to lose that's important, because you can't avoid losses. Losses are going to happen. Managing the loss is more important and more realistic. So shop around for some cheap calls across the high side. And if you find something that you're willing to lose, then that's the call, right? It's like going to the gas station to buy that $2 lottery ticket. It's only $2, right? What do you care? You know there's a snowball's chance in hell that your $2 is actually going to make you any money. But you do it anyways because, well, it's only $2. So it's a lotto play. Don't put a lot of risk into it, because it is a Wednesday tag, and this should have been traded on a Monday or a Tuesday if we got down there early enough. Not today. All right, we're still within my second collar. I've often talked about this imaginary box around the 10-day moving average, 0.5% above and below, and 1% above and below. Well, we're only just slightly outside of that 0.5% below. This isn't a negative bearish marketplace. We're just barely below the 10. And that's a good thing, coming back to the 10, getting a nice reset. If you want a good run higher, you want a good starting point. Getting under the 10 or at the 10 before making that next leg up, that's a real good starting point. It's a strong foundation to start a new trend from. I like it. We don't want extremes and we don't want violence, though. So none of these really big stick drop moves like this. But if we get 1% away and then we turn around and head back, then I'd still consider that good. And or from here, if we just turn around and start heading back up, that would be good. but we don't have to head back yet. We could hang out here for another day or two and say next week we could start to move back up. Looking at this, we're not oversold. We haven't moved too far too fast, and it does not owe us any sort of shot to the upside simply because of how far we've fallen. I don't even like to use phrases like oversold and overbought because it gives new traders the wrong idea. But we haven't sold off too much. And looking at our distance from the 10 week, we're still in a very good spot. We're still above the 10. And even on that last reset, we got right back up. Now the trend is clear. We can see it since, mid-June, these lower highs. So the expectation is that we're likely to put in another lower high, and that we've been trending down. How long it's going to last before we finally break that cycle and get a nice run again is hard to say. It wouldn't surprise me if we get a dip into the negative first. So we could get, a decent drop down before we get another move back up. Well, that was nothing, right? ADP just came and went, and the market didn't care at all. Still no market maker move. Hey, thanks for that. Where'd you see that? On Finance Juice? Trump is to speak to the senators at 7:30. So that could add a little bit of violence. There it is. Yep. It says 7:30, right? It's 8:30 for market time. All right, guys. The VIX is still up, but it's underneath that $20 line in the sand. As long as we're underneath that, then the market is just experiencing a pullback. If we get above 20 and actually hold above that 20, then we want to consider that the S&P and the NASDAQ are not just in a pullback, but they're actually forcing a deeper correction. Now, look, just wicking above that level doesn't count, right? We're talking about getting above it and staying above it, like we did back in October, right? When we had that real big stick move to the downside that we were just looking at. And then it took a little while where we were trapped inside of that big bar before the volatility subsided and we got back underneath that 20 line. So we're at the 20 line, but we got to get above it and close above it and stay above it. And then we would consider that we're in a deeper pullback or correction. We got Bitcoin trying to make some moves, but look at it. It's not even back to the previous day's high. So sure, it says Bitcoin's up almost 2%, but it's not even back to its previous day's high. It's got a lot of work to do. It took a serious beat down, so that's not done. Same thing with gold. It says gold is up this morning, but it's inside this really big bar, inside this broader range, and it's not at the low of the range. It's not at the high of the range. And this little gap up, it looks like a little bit of a dead cat bounce style behavior at this point. So let it get to the previous day's high, which happens to also be the 10. See if we can get through that and go higher. Then it would impress me. Otherwise, I'm not impressed. Silver is at yesterday's high or close to it anyways. So it's looking better. But even once it gets through that high, it's still got to get through the high of the range up here, 44.5. We don't know if this is going to be a higher low yet or not. If this candle comes down and breaks that low, then we're very likely going to go to this other low, right? 42 and 41.5. And then we would be putting in a new lower low or an equal low. So precious metals don't look good still. The fact that they're up today is nothing. Gold here, same thing. Mid-range, mid-bar, not even back to the previous day's high. Pot stocks are up. You don't want to rally on pot stocks. Solar is up, same thing. You don't want to rally on solar. And we need it at a 0.5%. We're not even there yet. Solar is a reflection of China, and we can see China names are up, but not up enough, right? Mags are up a tiny bit. We need those to really get into the game, and right now they're not. So we have the potential. We've got mags moving in the right direction. We want consumer discretionary, chips, cloud services, financials. We want all those moving to the upside. And we've got chips down 0.25%. Now, they're not down a half or more, so that's a good start. But we need those to turn to the upside. And they're basing here, but they're not running yet. Looks like we're starting to get a little bit of a 10-20 cross. We got to get it done and get that move to the upside. So watch for the liquidity gap. And as usual, it's GTFO, right? We got to get out of the box before we do anything else. The box right now is our own Globex range. Then we've got yesterday's RTH. And then all of yesterday's range. That's a lot of work to the upside that we've got to get through. The downside has a lot less restrictions. It's very likely after yesterday's big move that we just stay stuck inside of yesterday's range, right? That's really the most likely outcome because it's such a big range. And the data that we're getting so far isn't moving the needle all that much. So if the news turns really positive and can spike us, or really negative, because then they might think they're actually going to get that rate cut, right? We didn't think about that, but if it's crazy negative, that'll confirm the rate cut. That can pop us. Or if it's really positive, that could pop us. So it seems like either one, right? Just really negative news or really good news. But if it's this same old wishy-washy, we don't have anything and the government's still shut down situation, then expect to hold the range or bleed off. And you already got your lower levels, 6750, 6700, and then 6650, then 6550, that previous low back here, level by level by level. For the run back up, it's 32 and 50, and then back up to the roundy, and then the 50 up top. Easy peasy. So what I got for you guys, be careful, be safe, keep your eye on the clock. I'll see y'all tomorrow.